Welcome to the Trade Space Trading course. My name is Nick. Today we're going to be talking about inside bars, outside bars, and gap bars, and what they mean. This is a part of our Introductory to Price Action section of the course. Now with that being said, we need to actually discuss what is an inside bar and an outside bar. Generally be a pretty good place to start. Let's take this example here. If we're looking at this bull bar right here, this large bull bar, is this bull bar an inside bar or is it an outside bar? Well, it's an outside bar. Why is it an outside bar? It's an outside bar because this bull bar pushed above the high of the previous bar. It is an outside bull bar. Now let's look at the next bar, this bear bar. We can ask ourselves the same question. Is it an outside bar? Yes, it is. Why? Because if we look up here, we can see that this bear bar pushed above the previous bull bar by one tick and then closed bearishly. This is an outside bear bar. Let's look at the next bar here. Is this an inside bar or an outside bar? This is an outside bar. Why? Because it pushed above the previous bar's high, even if it's just by a tick. A lot of times in the market, especially when you're working with the 2000 tick chart, is you're going to see a lot of things that break something by just one tick. And every tick matters. Every single tick is important. And we want to look at everything and see where things close, see where things open. We want to try to see if there's any indication of price slowing or price speeding up. These are all things that we'll talk about throughout this course. Let's look at this bear bar right here. This bear bar is a little bit different. Is it an inside bar or an outside bar? It is an inside bar. Why is it an inside bar? It's an inside bar because it failed to push above the previous bar's high or low, making it an inside bar. Let's look at the next bar here. Is this an inside bar or an outside bar? It's an outside bar because it pushed below the previous bar's low. And the next bar is an outside bar. Notice we broke the previous bar's high by one tick. This one tick still matters. It still makes a difference. This bear bar here is an outside bar, followed by, as I'm sure you've guessed it, another outside bar, followed by an outside bar, and so on. Here's an example of an inside bar. This is an inside bull bar. This bull bar here did not break the previous bear bar's high or low, and therefore it is an inside bar. The following bull bar was almost an inside bar. We see it push down to the exact low here, and then it had a push up, and it looks like it closed one tick above the previous bar's high. This one tick matters. It is an outside bar. What is this right here? It's a gray doji. Is this gray doji an inside bar or an outside bar? It is an inside bar because it did not go above the previous bar's high or the previous bar's low. And if we go over one more again, we have another inside bar here. This creates an inside-inside pattern. Something that we'll talk more about later. Let's look at a few more examples here. Let's look up here. This gray doji. Is it an inside bar or an outside bar? It's an outside bar. It went above the previous bar's high. Following bar, outside bar. Following bar, outside bar. Next one, outside, outside, outside. Let's look at this one here. Outside or inside? Outside. It went below the previous bar by one tick. Sometimes when it's just on your chart like this, especially when it's happening live and you begin to feel stressed and you begin to feel anxious, sometimes identifying things that happen only by a tick can be really difficult. It's incredibly important now that you start the habit of being very disciplined at looking at the details, looking at the context of things. I can't explain to you how incredibly important it really is. Outside bar, just by a tick. Outside bar. Inside bar. Inside bar here. Outside. Inside bear bar here. Inside bar here. And here. Inside bar here. You might say, okay, well, it's pretty simple. I think I get the point. If it goes above or below the previous bar, it's an outside bar. If it doesn't do that, it's an inside bar. And yeah, that's pretty much the gist of it. But we can dive down a little bit further into detail, and we can look at things like, well, where do most outside bars occur? Well, most outside bars occur in a trend, like these series of trend bars here. 1, 2, 3, 4, 5. 5 trend bars. Here we have a series where we almost have some inside bars. They're outside, but they're not holding strong outside. And when we get into this area, we begin to get a lot more inside bars. We begin to range out a little bit more. Bears are not selling a whole lot in this area here. And they slowly picked up in here. Whenever we see an inside bar, where does an inside bar happen most often? It happens in trading ranges. Look at the amount of inside bars here. Inside bar here, inside bar here, inside bar here. And look at this range that's happening. The market's going down, but it's also ranging. It's not like in this section here where we have bear bars closing near their lows. We'll talk more about this later. I don't want to get into too much detail. I really want to focus on inside and outside bars. But whenever we just know that for now, whenever we see a lot of inside bars, we're probably in a range. If we're in a range, then the market is in a place of agreement, and it's going to stay in that place of agreement until it's not. With that being said, though, you have to be really careful in a range, because it may be in a place of agreement, but that doesn't mean that the market is just going to go straight to the top and straight down. It'll condense, it'll widen, it'll do a lot of different things. Some of the most frustrating trades are the trades where you enter and it turns out to be a trading range. And in that trading range, you get stopped out by 1 tick, 2 ticks maybe, and then the market continues on to hit your profit target. And you're sitting there, and you can't believe that this happened. And it can be pretty easy to throw in during a range because most of the time the market is ranging. It's ranging a vast majority of the time. We want to be really careful about not getting in during a range. We want to get in when the market is moving. Or if we do get in a range, we want to be real strategic about it. That is for a different video. Now let's talk for a second about gap bars. So what is a gap bar? Well, gap bar is real simple. It's basically just a gap between the open and the close of any two bars. So if we look over here, then we see a little gap here. And zoom in some more. It's only by about a tick, not a very big gap. We had a close here and open here. Put up some horizontal lines so you can see it a little better. Very tiny gap, about a tick. Let's get these out of the way here. There's some others out there. Some of them can be kind of hard to spot. Like this one right here. This bull bar has a gap in it, only by about a tick. Let's see if we can find another one. Let's see here. Small gap here. And there's a little bit larger gap between these bear bars here. You can find gaps just about everywhere. Now, if you'll notice, to give this demonstration, I did switch to the 5-minute chart. And the reason for that is because you're going to find more gaps on the 5-minute chart than on the tick chart, simply just because of the way that it's counted. Now, we can have tiny gaps like this all throughout our price. As the price goes on throughout the day, there can be little gaps here and there. Nothing too unusual. A lot of people say that the gap always gets filled. I would be very careful using or thinking with the word always, or will definitely, or is most definitely, or anything similar to that when it comes to the market. There is absolutely no guarantee of anything. There's no guarantee of you winning in any particular trade. And it's also the opposite. There's no guarantee of you losing any particular trade. Can you make money in the market without knowing what you're doing? Absolutely. People do it all the time. I mean, we can look at all sorts of wild bets throughout time, even if we want to go back into relatively recent history with like the whole Wall Street bets thing going on. Most people who bought GameStop didn't know what they were doing. Most people who bought it likely did not use any real form of sufficient analysis before they purchased GameStop. With that being said, a lot of them ended up with very, very large portfolios at the end of it all. The market doesn't care if you know what you're doing or not. It'll make you win sometimes, and sometimes it'll make you lose. Now, going back to gap bars, a lot of people say that the gap always gets filled. Well, there's no guarantee in anything. Using the word always is not a good idea. The gap actually gets filled about 50% of the time. And there's lots of gaps everywhere. A gap here, for example, it's kind of hard for this gap not to get filled. I mean, it's only like a tick. Little gap here, gaps in here. A gap can be caused from multiple reasons. Sometimes it has to do with the way that you're loading your data. Sometimes it has to do with momentum. Now, when we see little bitty gaps like this, it's generally not a whole lot to read into. Small bits of momentum, probably good for a very quick scalp on a really small time frame. However, if we start to see large gaps in price, then we can begin to know that there's some serious momentum. This is a screenshot that I took a while back showing some larger gaps in the bars. Gaps here, gaps here, gaps here. Notice these gaps are a lot larger. There's several ticks in most cases here. And just look at how quickly the market is falling. We can begin to stack our probabilities. We're in a bear channel here. Once we push up near it, we begin to have bar gaps. We begin to have bar gaps whenever the market falls. This is a signal of some serious momentum. Big gap in here. Whenever we're starting to see this on a 5-minute chart, we can then go to our 2000 tick chart, which we use primarily to enter on. Even though we can use any chart on any time frame, 2000 tick is really nice because it helps us to maximize our reward, helps to reduce our risk as compared to something like trading on a 5-minute chart. But we can still use the 5-minute to look at the overall picture of things. And once we begin to see gaps in the bars, we know that there's some momentum happening. We can use this on our 2000 tick chart to then go and try to find an entry.